Good afternoon, everyone. My name is Luis Quintanilla. I am a junior fellow from the International and Institute-wide Initiatives Department at the Lincoln Institute of Land Policy, and I would like to welcome everybody to this afternoon's webinar titled Improving the Property Tax by Expanding Options for Monthly Payments, hosted by the Lincoln Institute. Today, I will serve as the moderator of this session. And before introducing our speakers, I would like to note that this webinar is part of the Institute's series of programming in support of our Municipal Fiscal Health campaign, which was launched in 2015 to help restore local government's capacity to provide basic goods and services and plan for the future. We have been carrying out the campaign by mobilizing new research and developing tools and programs that promote fiscal health domestically and internationally. And even though the causes of fiscal stress are complex, we know that land can play a significant role for metropolitan regions in the maintenance of basic city services and the funding of infrastructure. So at the Lincoln Institute, we have identified 6 pillars of municipal fiscal health that provide a framework to advance financial solutions across governments. And one of those pillars that we identify as a crucial contributing factor to sound fiscal systems and relevant in this presentation is land-based revenue, and more specifically, the property tax, which in the US is the largest revenue source controlled by local governments. And therefore, the purpose of this fourth installment in our webinar series is to discuss how local governments can improve their property tax systems by allowing taxpayers to pay on a monthly basis, which I think it's an interesting idea. Now, it is my pleasure to introduce our speakers for the webinar who will cover this topic. Adam Langley, who is a senior research analyst at the Lincoln Institute of Land Policy and the author of the report Improving the Property Tax by Expanding Options for Monthly Payments. We also have Cindy Land. She is the administrative deputy for Marion County Treasurer's Office in Indiana, and she will talk us about Marion County's Flex Pay Plan. And by the way, Cindy is doing Marion County's presentation on behalf of Treasurer Claudia Fuentes, who unfortunately was not able to attend today, so we very much appreciate Cindy stepping in her stead. We also have Jim Claiborne, Deputy Treasurer for the City of Milwaukee, and he will talk about Milwaukee's monthly property tax installment plan. And Vincent Reyetano, Public Finance Associate at the Government Finance Officers Association, who will talk specifically about investments on collection systems that will be needed to migrate to a scheme of monthly property tax payments. Welcome, Adam, Cindy, Jim, and Vincent. Thank you for being with us this afternoon. We are going to begin today's webinar with our speakers' presentations for approximately 40 minutes, and then we will continue with a Q&A segment for about 10 minutes. We ask our audience to please use the chat function if you would like to submit questions. And after the Q&A, we will close the webinar by providing some resources and links where you can download publications to learn more about the topic that we will cover today. So without further ado, I'm going to turn the presentation to our first speaker. Adam, thanks again. Take it away.
Okay, thank you, Luis, for getting us started today. And thanks to everyone listening to us for joining this webinar about improving the property tax by expanding options for monthly payments. So when I first mention monthly property taxes, a lot of people assume that I'm talking about the fact that many Americans pay their property taxes rolled in with their monthly mortgage payment. But as a matter of fact, property tax escrow accounts managed by lenders like banks are not nearly as common as many people believe. In fact, in 2015, less than half of all homeowners, 44%, paid their property tax as part of their mortgage. More than half, 56%, pay their property taxes directly to their city or county government, typically once or twice a year. And that includes 20% of homeowners who do have a mortgage but do not have a tax escrow account with their bank, and then 36% of homeowners who don't have a mortgage. And it's also important to note that there are major differences across age groups on this issue. Amongst homeowners under age 65, more than half, 55%, pay their property tax as part of their monthly mortgage. But amongst seniors, 80% of those over age 65 do not. They pay their property tax directly, typically once or twice per year. And all of these homeowners paying their property tax in large lump sums turns out to be a problem, because we know that there are a lot of households who really struggle to save for large irregular expenses. In fact, there was a survey done by the Federal Reserve that found that 46% of Americans could not come up with even $400 for an emergency expense. Now compare that to the median property tax bill in the United States, which is over $2,300, and you can see that there's a potential problem here. Really, we're requiring people to save in advance for their property taxes, and if they don't, there's not that many Americans who are going to be able to afford a tax bill of $2,000, $3,000, $4,000, $5,000 with cash on hand. But if you split that median tax bill up into a monthly payment, it's a lot more manageable, a little under $200. And if you think about it, it's really not that surprising that billing in large lump sums rather than on a monthly basis could create problems. I mean, if you do a little thought experiment, you can imagine what might happen to the mortgage foreclosure rate in the country if mortgages were billed on an annual basis rather than monthly, or what would happen to income tax collections if the withholding system were eliminated. You can see that there likely be some new problems, but we still do bill the property taxes on just 1 or 2 times per year in most places. So that's one problem caused by billing property taxes on an annual or biannual basis, the financial challenges that it can create for homeowners who struggle to save for large irregular expenses. But there are other problems as well. A second problem is that billing property taxes on an annual or biannual basis could increase the property tax delinquency rate. After all, those homeowners who have not saved in advance for their property tax and they get that large tax bill of $3,000, $4,000, $5,000, they only have so many options to pay their bill. One option, they could borrow money to pay their property tax, which would typically mean building up credit card debt. A second possible response to that tax bill would be to skip some of their other bills to pay their property tax, maybe becoming late on a mortgage. But then the third option for a property tax bill that they don't have the money for is that the homeowner could not pay their property tax bill on time and become delinquent. And there are real consequences of delinquency. Homeowners typically face interest charges and penalties, and ultimately in the long run, they could actually lose their home from tax foreclosure. And there is some evidence that billing in lump sums can increase the delinquency rate. For example, there was a study of Wisconsin municipalities, and that found that increasing the number of installments from 2 to 3 payments per year reduced the tax delinquency rate by about 1/3. So it's a pretty big effect. And then a third problem caused by billing property taxes in large lump sums is that it can foster political opposition to the property tax and erode municipal fiscal health. And the reason for this is that paying in large lump sums makes the property tax a very salient tax. In other words, people are more aware of what they're paying in property taxes than in income or sales taxes. Now, certainly there are benefits of this salience of the property tax, but there are also some downsides. For example, there was a study done by 2 researchers in 2012, and they found that the salience of the property tax increases political opposition to the property tax, which in turn increases the number of property tax limits and other policies to reduce property taxes. And the problem here is that many of these policies have some serious unintended consequences that can erode the fiscal health of local governments. And then a final problem caused by billing property taxes on an annual or biannual basis is it means that local governments are only getting their property tax revenue once or twice per year. So it's an irregular revenue inflow. So to meet their regular spending requirements like payroll, Governments need to rely on short-term borrowing or hold large amounts of idle cash in safe and liquid assets that are not going to earn them much interest. So, bottom line here, there's a number of problems caused by billing property taxes on an annual or biannual basis, but the good news is that there's a straightforward solution here, which is that state and local governments can allow monthly property tax payments. And in the US, there are currently two approaches used to allow monthly payments. The first are prepayment programs, and these are allowed under state law in at least 16 states, although the number of local governments that have actually established prepayment programs is still pretty small. There are some notable examples of places that do allow monthly prepayments. For example, all the large counties in Ohio have prepayments. That includes the counties serving Cleveland, Columbus, and Cincinnati. Another notable example is in Iowa, where the Iowa County Treasurers E-Government Alliance allows taxpayers in 56 of the state's 99 counties to set up monthly recurring payments. And then another example is in Marion County, Indiana. And we're very fortunate that our next speaker, Deputy Treasurer Cindy Land, will describe how Marion County's FlexPay plan works. And just to avoid any confusion, I should note that these prepayment programs, they go by many different names. They're sometimes called prepayment agreements, property tax escrow accounts, monthly installments, early payment plans, or simply monthly property taxes. But regardless of what they're called, they all pretty much work the same way. A second, very different approach are monthly property tax installments, which are used in Milwaukee, Wisconsin. And our third speaker, Deputy Treasurer Jim Claybor, will describe Milwaukee's approach. So there are a lot of similarities between the prepayment programs and monthly installments. One similarity is that they both work as a local option. So what this means is that state governments allow individual local governments to start a monthly payment program if they want to. But monthly payments are not required for all local governments, and they are not necessarily available on a statewide basis. And there's actually a good reason for this approach of using local options. And that is that there are large differences across local governments in the upfront costs to start accepting monthly payments. And that really depends primarily on whether their existing software for tax collection allows them to track monthly payments. If it does, governments could usually start accepting monthly payments easily and with practically no costs. But if their existing software cannot track monthly payments, then those governments would need to spend hundreds of thousands, maybe millions of dollars to implement a new property tax collection software module. And our fourth speaker, Vincent Raytano of the Government Finance Officers Association, will provide more detail about the software costs. But the basic point here is that with a local option, states can avoid imposing any costs on local governments unless those local governments choose to start a monthly payment plan. And then a second similarity between prepayments and monthly installments is that there are a number of different payment options available to taxpayers. Governments typically allow taxpayers to set up a monthly payment with a transfer from their checking or savings account using an automatic clearinghouse, ACH, or an EFT, electronic funds transfer payment. And then other options are to mail in a check each month or pay via credit or debit card. Although credit and debit cards usually incur high transaction costs, typically 2.95% of the transaction, and those costs are almost always borne by taxpayers. So in practice, credit cards are not a very popular option. Now, in addition to these similarities, there are also some important differences between prepayments and monthly installments. One difference is with prepayment programs, taxpayers need to submit an application before they can start paying monthly. In contrast, in Milwaukee, there's no need for an application. Every tax bill includes the option to either pay in full or in monthly installments, and then the taxpayers are automatically enrolled in the monthly installment plan when they make their first monthly payment. A second important difference is whether or not escrow accounts are used to hold monthly payments. With prepayment programs, they are. And the way it works is that the monthly payments are sent in by their taxpayers, and they're then held in an escrow account that is managed by the city or county treasurer. Then those monthly payments accumulate in the escrow accounts, and then at once or twice per year, the payments in the escrow account are taken out and used to pay off a taxpayer's annual or biannual property tax bill. And at that point, once or twice per year, the payments are distributed to taxing districts. In contrast, in Milwaukee, there are no escrow accounts, so the funds are distributed to local taxing districts every month. And then a third important difference is that participation rates are much higher on the monthly installments used in Milwaukee. In Milwaukee, about 20% of all taxpayers participate in the monthly installment option. And if you're to look just at those homeowners who pay their property taxes directly, they're not already paying as part of their mortgage, you end up with about a third of all people paying their taxes directly using the monthly option. So it's a pretty high number. In contrast, under prepayment programs, participation rates are usually low, under 5%, and often 1%, 2% or less. And certainly there are a number of factors at play here, but likely the biggest reason for the large difference in participation rates is that Milwaukee allows people to enroll automatically without an application. So it's just easier. And there's a lot of research in behavioral economics showing the importance of these default choices. So let me take a minute to wrap up. Our current situation is that in the United States, more than half of all homeowners pay their property tax in just one or two large lump sums each year. And that includes 80% of seniors. And this causes problems. There are the problems caused by billing property taxes on an annual or biannual basis are that it can create financial challenges for homeowners who are not good at saving for large irregular expenses. It can increase the property tax delinquency rate. It can increase political opposition to the property tax and lead to tax limits and other policies that erode the fiscal health of local governments. And it requires local governments to deal with irregular revenue inflows. But there is a straightforward solution here, which is that state and local governments can allow monthly property tax payments. And there are currently two approaches used for monthly payments in the US. There are the prepayment programs, which are allowed under state law in at least 16 states and used in places like Ohio, Iowa, and Marion County, Indiana. And then there are the monthly property tax installments in Milwaukee. So thanks everyone for your attention. And now I'd like to turn it over to Cindy Land to talk more about Marion County's FlexPay plan.
Thank you, Adam. Again, my name is Cindy Land. I'm the Administrative Deputy for the Marion County Treasurer, Claudia Fuentes, and she's so sorry she was not able to participate today. We've had an outbreak of the flu in Indiana. So in Indianapolis and Marion County, and if we can go to the next slide, I'm not sure if I'm to be, Marion County is located in Indiana and is the home of the city of Indianapolis. The treasurer is responsible for billing, collecting, investing, and distributing property taxes. And to give you an idea of the size and volume, we collect on behalf and bill on behalf of 39 units of government, which includes 11 school districts, 13 cities and towns, 2 transportation units, 2 libraries, 9 township trustees, our health and hospital department, and of course the county. We send out 380,000 property tax bills annually, which we would like more people participating in e-billing. But in those, we have 4 different types that we send out. One is the auto pay, which are those that pay twice a year and have us automatically debit their account. We're advising them the date that those are going to be paid and pulled out. We have the monthly, which are the flex payments that I'm going to go into more detail that happens monthly. We also have those people that have a mortgage escrow company that is billing for them or paying paying on their behalf, that they get a bill that says this is not a bill, but this is how much your mortgage company is paying on your behalf. And then we have regular bills that go to those people that are paying, and then e-bills. The tax bills, again, are due every May and November, and we mail those in April. A second mailing occurs in the fall only if there's been adjustments to those bills, or we have delinquencies because of non-payment or change of ownership. Now, to share a little bit, what Adam was talking about, 40% of our payments are mortgage payments, and 13% overall are our online payments. The levies in Marion County for all of the units of government are around $1 billion. We bill 18 different types of special assessments for the units of government in addition to that for around $49 million. And we have about a 3% delinquent rate. But again, I think all these various payment options have increased and improved our payment methodology. So going on to the next slide, the Flex Pay. Marion County's Flex Pay is a monthly prepayment plan that we actually requested a vendor to develop for us. And it has flexibility to deduct in 6 monthly payments from their checking or savings account. In order to be signed up to be paid in full by the May due date, and they would have to have those payments begin as early as December. And then the November due date, they would have to begin as early as June. Annual bills are calculated in March and mailed in April. And in order to start this program that we would bill in December, we create in December, or actually after our May or after our November due date, we create invoices using an estimated bill, because you can't create a bill and bill someone for something if you don't have an amount. And so we've created, and we'll share in another slide here coming up, what our estimated invoice is, but we end up having used the prior year's values and estimating what that prepayment amount will be. And prior to that, we call it a reconciliation. So once we've received the tax rates and we've calculated the bills, it will either increase or decrease their bill in their April and May invoice to true up, is what we call it, to true up that bill. So this shows the sample invoice. In addition, we have, besides the tax, we have 2 other items that everybody has a bill for stormwater and solid waste for trash pickup in our county. So this is showing a sample billing that we've used, saying this is what it is. If you sign up for the Flex Pay option, it would be 6 payments, and that payment would be $62.87 a month. So next slide, they have to, again, designate each spring or fall cycle the day of each month that they want to deduct from their account. And although the plan was originally designed for 6 monthly payments, there are some people that want to even have it more frequently for them. We were able to work out that the fee was 25 cents per deduction, provided it was 6 or more, which ends up not being very much, as opposed to driving downtown and paying your taxes, waiting in line, having to go through security. But even the 95-cent fee, if you do less than, again, it's a convenience, and it's up to them to determine what works best for them. And so prior to whatever they decide or determine to sign up for, they do get email notifications and reminders. So the next is showing then when they go in, if they select in the program their parcel number and the account they select. It could be an owner has multiple accounts, and so they can select several, and that's one other benefit. If you have multiple accounts that you're wanting to do, if you sign up and select multiple parcels, it's still only a quarter, even if you're paying on 2 or 3 parcels. So again, we feel like it's a great benefit. So they are picking the invoice that they decided they wanted to sign up on. So the next slide then says, how is it that you want to pay? Do you want to pay with a flex pay option, or are you just paying today, or do you want to do a scheduled payment and schedule different payment dates because you know you're going to be out of town and want to make other plans on this? So then next slide is saying how they want to pay. So is it an e-check? What kind of account, savings, checking account, and then showing what the total invoice is for them for what those payments are. So that shows your payment option. And then the scheduling payments is the next slide that shows what dates. It's so flexible. Instead of saying, I'm going to pay on the 10th of each month and it just automatically does, they know exactly what's their cash flow, when it's coming in, so they can determine what day each month even that they want that payment processed. And so all of them are required to pay. If they want to pay before the due date for their very last payment, that's fine. But flex pays are scheduled so that it does not exceed the due date. And so it can't exceed the due date. So this shows, what is the first payment date to process, what is the last payment date to process, and what that is. And then the next one is the schedule that shows every single month and what was the date each month. So you see we had January 31st, February, March. We had 2 in April. So again, it's that flexible that you could have multiple per month if you so desire. And so once they finalize that, they can finalize and review that information and finalize that payment. And then they will receive text messages, and they can also sign up for paperless if they want. So that finalizes the transaction for them. So it's very simple. And then the next slide is just showing the confirmation email. And I'm sorry for how, again, trying to get it all to fit on a page, it's not giving you really clear, but again, it shows what they have signed up for. And again, it summarizes their payment schedule. So it's a confirmation. So benefits to the taxpayer, it ensures that taxes are paid every May 10th and November 10th. They can spread those payments over 12 months and rather than 2 large payments every year. I've always indicated, how would you like to pay your cell phone bill twice a year? This is something that, again, has made it a lot easier for a lot of people, and especially the senior community that are on fixed incomes. So the benefits to the county are that the property taxes are the largest source of revenue, and the plan could increase. We'd like to see it grow more than it has, but it increases cash flow throughout the year that otherwise would be limited to a spring and fall. We also do advances to our units of government, so it can help them as well when they're having to ask for tax anticipation notes for their cash flow. It can reduce what they're required to perhaps borrow. And it also helps us with costs because cashing checks versus doing payment files, having people walking in over the counter with customers. We just have a lot less people that are actually walking into our office than what we used to. And then it increases our interest earnings as well. So the county invests, and that's money that helps generate revenue for county government. So again, based on a county of our size, we are working with our ISA computer firm, and we are doing some new development. So we are hoping that we can do some more outreach and advertisement. We have 592 participants in the program currently. In 2017, we collected, 7.9 million, over 13,000 payments, and it's about 1% of our tax collections. So again, our goal is to continue to have this program grow. So with that, thank you.
Great. Thank you very much, Cindy. It is now Jim's turn to talk about Milwaukee's monthly property tax installment plan. Jim?
Good afternoon, everyone. Thank you, Louise. So the city of Milwaukee has a 10-month interest-free installment plan. Under Wisconsin state statutes, the Milwaukee Common Council is permitted to have 10 installments without interest for city taxes, and the county taxes can be paid in 7 installments without interest. And special assessment charges, with the exception of business improvement districts and neighborhood improvement districts, can also be added to the city tax roll and can be paid in 10 installments without interest. And to exercise that option, one need just pay the first installment on or before January 31st. We have no application form because in Wisconsin, the combined property tax bills go out in December, and payment in full is due on or before January 31st, or you have to be making your first installment payment. Next slide. So in the city of Milwaukee, the city property taxes are for 3 taxing jurisdictions: the area technical college, the public schools, and of course the city. And county includes 2 taxing jurisdictions, the sewage district and Milwaukee County. And in 2016, there were 6,133 special assessments added for over 700,000, and there were 125,168 special charges added for over 54 million. So you can see the advantage of having to pay such large bills all at once compared to having it spread out over 10 installments. Next slide. So at the close of the 16 tax levy current collection period, 116,000 people had paid in full. That represents about 72%. And then we had over 33,000 accounts on the installment plan, which represents about 21% of what we billed. And then we had 12,000 folks that did not pay in full or go on the installment plan that did go tax delinquent out of a total of 162-some thousand billed. So in Milwaukee, you have several options to pay your taxes. You can pay by mail to the lockbox. You can pay in person at one of 12 U.S. bank branches within the city. You can enroll in our automated ACH debit installment plan. And there we do require an enrollment form under NACHA rules, and people send us either a deposit slip or a check so we have the correct account number. And we debit accounts on the 25th of every month. Even though taxes are due on or before the last day of the month, we do this debit on the 25th so that if somebody is insufficient in funding their account, they still have a few days to make good before they miss or go delinquent. You can always pay in person at City Hall during normal business hours, and we do have a drop box at City Hall that's available 24 hours a day, 7 days a week, 365 days a year. And beginning this year, you're going to be able to pay online outside of December and January, what we consider the current tax collection period, that you'll be able to pay year-round online by either ACH debit, and that's without any convenience fee, or by debit or credit card, and there is a convenience fee of 2.75%. Each one of our combined property tax bills does display the full payment due and then the first installment payment. And off to the side of that, it also shows what your monthly payment will be February through July, because that would be city and county. And then the 3 final installments in August, September, and October, which is just the city share. Then the payment coupon lists those 2 amounts that are due, the full payment or the first installment. And so, again, you can mail in your payment, or you could pay online, or if you're enrolled in the automated EFT plan, instead of having that OCR scan line there, it says do not pay, your account will be debited. Now in Milwaukee, you're not prepaying. Taxes are due on or before January 31st in full, or you have to make your first installment. So you're making an installment on what is due. You're not prepaying in advance. So what we consider first-time delinquent is when a taxpayer misses or pays short a monthly installment for the first time. And in that case, they can be reinstated to the installment plan by paying the missed or short amount with 1% interest along with the next month's installment. And then you're back on the plan. And we're billing people on a monthly basis. We're on a monthly cycle. And then you would go permanently delinquent if you miss or pay short a second time. And you go permanently delinquent, and interest and penalty accrues on the remaining tax balance back to February 1st. And in Wisconsin, the interest rate is 1% per month, and penalty is at 0.5% per month. So we try to make it as easy as possible for folks to get on the installment plan. So instead of having that big payment once a year in December or January, you can pay on the installment plan. And I would think that now that the federal government has changed the standard deduction by doubling it, I would venture to say a number of folks who may have been able to itemize in the past will now just be taking the standard deduction, and instead of trying to get that tax bill paid by the end of the year to get it on their income tax return, we may see more people opting to go on the installment plan now and just pay it over 10 months without interest and penalty.
Great. Thank you very much, Jim. Next, Vincent will talk about investments in tax collection software to enable monthly property tax payments. Vincent?
Hey, well, good afternoon, everyone, and thank you for the opportunity to speak on this webinar. And as Luis said, I'll be presenting on a working paper that I wrote for the Lincoln Institute, and you can see the title right on the screen. The working paper, just to briefly give an overview, it looks at collection software. It includes a survey. And in this survey, it captures local government collection software. And I'll be talking a little bit about the survey throughout the presentation. And then it also looks at best practices for switching to monthly property tax collection with installment plans. Now, as Adam detailed earlier in the presentation, local governments depend on the property tax to fund public services. Now, the property tax is often considered to be one of the most unpopular taxes, in part because demonstrating the proportional equivalence between the cost of property taxes to the benefit of the property tax is difficult. The property tax is also highly visible, and it has to be paid in small 1 or 2 lump sums. And really, there are no behavioral incentives around property taxes at the moment. And that really challenges the ability of taxpayers to actually pay this. And there's, of course, a mismatch between taxpayers who receive their check on on every couple of weeks or on a monthly basis relative to a lump sum payment. That really creates a disconnect and issue for these taxpayers. Now, Waltard and Ryschowski in 2012 wrote a paper, and they use an econometric model to test the relationship between higher frequency property tax payments and delinquency rates. They use a panel of local governments in Wisconsin, random effects econometric approach. And they have two key findings in this report. And just to summarize and build off what Adam said earlier, the first is increasing the number of installment payments from 2 to 3 per year reduces the delinquency rate by about 1/3. And in addition to that, allowing more than 3 installment payments does not lead to a statistically significant reduction in the property tax delinquency rate. So I think it's a very interesting and informative paper. It's really the only of its kind at this point. And I think it really shows that there's a lot of promise here, but we need more research to continue to build support for this idea of monthly property taxes. Now, although it's not widespread, installment plans for property tax are actually used throughout the U.S. There are different characteristics, and in my research, talking to governments and also software vendors, tend to be some key characteristics. The first of which is eligibility. Eligibility in terms of age or disability status of the individual may qualify them to pay on a monthly or a quarterly basis. In addition, the installment frequency, whether it's monthly or quarterly, and then finally, autonomy, that the taxpayer can often opt into or out of the program. As far as I've found in my research, there's no government that requires that everyone pay on a monthly basis at this point. Now, there are different examples that I referenced in the report. Some are Toronto and Calgary. They offer 2, 6, and 11th month authorized payment plans. Philadelphia actually has an electronic monthly installment for residents over 65 years of age. And in addition, Bexar County, Texas, allows for installments for residents over 65 years of age, disabled individuals, and veterans. And those are just a few of the examples that are referenced in the report. There are many others. Now, GFOA conducted a random sample of 398 local governments, and we found that about half of mid-sized to large governments use homegrown systems that they created themselves rather than a dedicated vendor software or ERP platform, such as CGI, Infor, Oracle, SAP, Tyler, and many others. But still, a sizable portion do actually use Thomson Reuters and Tyler technologies, especially for small to medium size. And this is just a brief overview of the survey findings. You're more than welcome to report more detailed insight into our findings. Now, there are a variety of factors in system replacement. They include the size of government. Of course, larger governments requiring more licenses for these different financial systems and having more residents to cover, so that can reduce the complexity and the cost and the time of implementation. Of course, if they're homegrown and if they're going to a system upgrade, they need to have the internal capacity to develop their own homegrown system. Whereas if they're upgrading their system, with an existing software platform such as Oracle or SAP, there may be less of a cost or no cost if it's inherent in their program. And another factor that often is not considered is change management. That really gets at the human capital side of financial systems, in that switching from an annual or biannual to a monthly basis requires both technological change but also human change. Requires administrators in local governments to really change how they think about property taxes, budget around financial management, and potentially how they deal with citizens. So those are 3 key factors in system replacement. Now there's some questions to consider. I have 3 here, and there are a couple of others in the report. The first is, how will a change to property tax collection systems affect other tax-related functions and systems? Second is, how will a change to property tax collection systems affect non-tax functions and systems related to financial management and performance management? And then finally, will there be increased administrative costs with monthly tax installments? For example, will there need to be additional administrative staff to process higher frequency of payment? And there really are no set answers to these questions. Local government needs to sit down and analyze its own context to be able to answer these. And of course, they can hire an implementation firm to help them work through these questions. So there are many ways of actually going about this, preparing for an effective system replacement. Now, there are different needs when making the switch to installment property tax plans. A homegrown system that's being upgraded should consider if internal IT, budget, and finance staff have the capacity to make the switch. And in addition to that, cost-benefit analysis should be run to see if it's worthwhile to keep the homegrown system or to potentially upgrade to a vendor system. And if there is a decision to go from homegrown to a vendor system, there actually is evidence supporting that. That research shows that vendor systems generally have greater security and stability, and that's particularly critical, given the workforce in local government, and that as experts who have 30 years in local government are starting to retire, they may take that knowledge around the ERP and the financial system with them. They may not leave it with the government, and then a homegrown system might be very difficult to fix and upgrade over time. Whereas if you're working with an external vendor system such as Oracle, SAP, Tyler, or many others, they have dedicated staff who build and upgrade these systems, billions of dollars into R&D. So there are a lot of opportunities out there to not have to depend internally, but on external resources from these systems. And I think another consideration is the organization ready for implementation of change management? And like I was saying earlier, that really gets to this concern about human capital. And that switching from annual or biannual payments to monthly payments is a large paradigm shift for local government, and you have to make sure that the employees in the local government are ready to do that. Now, cost estimates are provided on this slide. There's more detailed discussion in the report around these, based on talks with different vendors and our own expertise and knowledge within GFOA. We estimate costs of small government. Low estimate for small governments for the software to be anywhere from $25,000 to $150,000 on the high estimate. And then, of course, there are project costs for implementation. The costs do escalate for larger governments, and that's standard for any financial system. The low estimate is $750,000 for large governments. The high estimate is $3 billion. And of course, the implementation costs scale up as well. So again, I asked that if you want more information, you're more than welcome to report for how these numbers were obtained and how they may relate to the context. Now, as far as the steps in the process, there are different ways of going about this. You could start with a request for information or an RFI, and you could send that out on public procurement sites. And you could see basically how vendor offerings are out there in relation to the needs of your government. Now, in the event that you like what you see, you've decided to make the switch and you're going to try to have a monthly property tax system, you need to put out then an RFP or a request for proposal. That will start the formal public procurement process. Now, of course, this is a long process. You probably need a project manager internally to begin this successfully. First, you want to actually receive the response to the RFP from different vendors for these financial systems. Then you have to internally evaluate the vendor responses and select vendors to interview and demonstrate their products. Interviews can be typically anywhere from a few hours to a whole day, and product demonstrations can last anywhere from 3 to 5 days. This will actually require that these vendors come on site, free of charge. This is all based on their internal resources, and they demo their product and show its relevance and its utility for your local government. Now, typically after these interviews and demonstrations of the products, the government will then evaluate the different vendors. This, of course, has to be done within public procurement rules. You have to look to your own public procurement agency experts, and they differ by state, by local government. After you've done that evaluation, you, of course, then have to go into the process of selecting one and then writing up a contract. And then while you're doing all of this, it's important also to do a business process analysis, where you're actually mapping out different business processes. For instance, each individual step in collecting property taxes. And as you map out, these different processes in a program such as Microsoft Visio, you're then able to translate that into the financial system. Now, once you've made the decision, you have your business process analysis finished. You then have implementation, which could take anywhere from what we estimate 200 to 500 hours for this particular option, and then you have a go live, where the system actually is up and running, and you're collecting on a monthly basis. Now, there are a variety of questions to consider when making the switch, such as the institutional context. Is a local government allowed to offer property tax installment plans? So you need to look to your internal legal experts if the state allows it. The local context, how will citizens react to property tax installment plans or pre-authorized payment programs? And will their behavior change? Will they actually use this? If you have a very low delinquency rate, does it make sense to actually invest in that? System configuration, is there a plan in place for implementation? Finally, long-term support. Will the software provider support the product over time? So these are all different factors to consider when making the switch. And it's good to actually sit down with experts within your government, write down answers to these questions. so you're prepared for any potential contingencies that may arise during this. Of course, this is a complicated process that will take a while to make the full switch. Now, in terms of benefits for monthly installment plans, Adam, of course, talked about these, but just to recap and conclude the presentation, increased adoption of installment payments is associated with decreased delinquency rates, and we have statistical evidence from the Waltart and Wachowski paper in 2012. This can lead to greater stability of revenue collection, so of course that could potentially contribute to municipal fiscal health. In addition, on the other side, so for citizens and taxpayers, there's better alignment of personal budget behavior of citizens and local government budgeting. And finally, one thing that is harder to quantify is the trust between government and citizens. And I pulled a quote from Coconut County, Idaho, where they're talking about their installment plan and how it provides helpful services to our residents. And then also in Kalamazoo, Michigan, which is actually part of an austerity plan to help citizens who are struggling to pay their property taxes. So these monthly installment plans can help citizens, they can help government, and overall build trust, in local government. So there are a variety of potential benefits from making the switch.
Great. Thank you so much, Vincent, Adam, Cindy, and Jim as well for such terrific presentations. And now I would like to begin the Q&A segment of our discussion, and we have about 10 minutes for this. But first, I want to remind our audience to please write your questions using the chat box, as we're gonna collect all the questions you submit and provide them to Adam, Cindy, Jim, and Vincent, so that they can be aware of them and hopefully address them all. Okay, so I want to start with a general question for Jim and Cindy. And I mean, based on your experience, what do you think are the main advantages and perhaps also disadvantages of allowing monthly property tax payments? I mean, in practice, are monthly payments difficult to administer, or is this something that you think more governments should try? So, Cindy, would you like to go first?
Sure, be happy to. It's my opinion more governments should offer it. Again, it gives flexibility to taxpayers and helps them. And so if it helps them, it definitely helps us as far as collecting that revenue sooner. It's also easier because we're getting a payment file from our vendor. So instead of staff manually having to process a check and the costs for sending checks to the bank and having those cash, it's reduced our fees as well. So again, it's absolutely a benefit to us.
And I would certainly agree that why not offer people the option to have an installment payment instead of coming up with, thousands of dollars once a year, because most of us aren't disciplined enough to set that money aside so it's there when you need it. So it makes sense to offer an installment plan for folks. So especially, with more boomers retiring every day, more and more people are going to be on fixed income, and this certainly makes it a lot easier to just have it be part of your monthly expense than to try to come up with a huge sum right during the holidays.
Absolutely. Thank you, Cindy and Jim. We also have a question for Adam. I mean, it's clear from your report that you have studied a lot of different approaches for monthly tax payments. So in addition to what's already been discussed, what else should state and local governments do to make these programs more effective?
So there are a couple of things that I think local governments can do to make prepayment programs more effective. One thing is to try to create more established processes to help taxpayers pay monthly. There are some places that I learned about in the course of my research that allow people to pay on a monthly basis, but these are really ad hoc, one-on-one agreements reached between taxpayers and tax collectors, typically for people who have just regularly had trouble paying their taxes. There's nothing on their website. There's no application form. So it's really putting a lot of burden on the taxpayers to figure out how much to pay, talk with their tax collector on a one-on-one basis. Those places that have the forms to sign up, and they estimate how much people should be paying each month, and do those other steps, have programs that have more participants and just make it easier for taxpayers. Also, I would say it's important to try to encourage automated payments, such as in Marion County's FlexPay plan, where you're pre-authorizing the payment. One of the not trivial causes of tax delinquency is just that people forget to pay their taxes. And so by going to monthly, you could risk actually exacerbating that problem. So with an automated payment, there's no need to remember. And then finally, I think it's important to use outreach and advertising to spread the word about the monthly payment option to increase participation rates, because they often are pretty low. I've learned about a couple of different ways to do that. People put notices on the outside of the tax bill, on the envelope. It's kind of a high profile place to put it. Or you can put a little trifold flyer in with the tax bill, those sorts of things. So no one's going to miss that option, as opposed to burying it in small print in the backs of a tax bill.
Great, thank you, Adam, for that. We have another question. This question is for Vincent. So I'm really interested in the idea of governments sharing the cost of tax collection software with shared service arrangements. Could you elaborate a little more on how this works, and perhaps give example of places that are doing this, Vincent? Vincent, can you hear us?
You're on mute. You hear me now?
Yes.
I'm sorry, my internet went out. Can you please restate the question?
Oh, so it's about the idea of governments sharing the cost of the tax collection software with shared service arrangements. Could you give examples of places that are working or doing this, or elaborate a little more on how this
certainly,
works?
certainly. Yes, so I think shared services offer a lot of promise for local governments throughout the U.S., and that they could reduce costs, but they could also lead to sharing of knowledge and expertise about financial systems. It seems that knowledge and expertise can really help, especially when someone is new to government. I think a great example is the Minnesota Counties Computer Cooperative, and they have, as far as I remember, they do have a full website that details their operations. I have a quote from the homepage of their site. And they offer software and other cost-effective measures to substantially reduce technology costs for counties, cities, and agencies. And as far as I understand, they actually have simultaneously adopted similar software systems, so they could reduce costs and also share expertise for how to service the systems, how to upgrade them, and things of that nature. So I do think that there is a lot of opportunity for governments, whether in a small region or at a state level, to work together. And I think all it really takes is just a simple email. Email your local government, practitioner, couple cities down, and see what they're doing, and just set up a conversation. And there's always a possibility for collaboration for shared services.
Great, thank you so much, Vincent. I think we have time for one more question, and this one is for Cindy. If you don't mind, Cindy, we're interested in how long has the Marion County FlexPay plan been working? Do you know if it was difficult or costly to start this program?
No, it was not costly at all. And actually, I don't think the vendor would want to try to do it again. But we were able to implement it within a 60-day window. But actually, it was implemented in 2011. 2009, the law changed that afforded us this ability to do this. And I mean, we pay a monthly fee to our online vendor. Again, it is integrated. They're integrated with our tax vendor. and so they can pull bills up live online, real time. And so again, I think it's great having them work together, and again, it's been very beneficial. So again, since 2011, and so we're very pleased with it.
Great. Well, thank you to all our speakers. Thank you so much again to our audience for joining us today. Unfortunately, we're running out of time, but I think this has been a very interesting session. We appreciate everyone's participation and hope you have enjoyed the conversation. Before we conclude, I would like to invite you to visit the Lincoln Institute's website and find some of our publications and resources related to this session, including Adam and Vincent's full reports, which you may find in the working papers section that is within the publications menu on the main web page. And in addition, we have several resources for those who want to learn more about the property tax, including our policy-focused reports on property tax assessment limits and property tax circuit breakers, as well as the book Good Tax, Legal and Policy Issues for the Property Tax. Lastly, I also want to invite you to consider our quarterly magazine, Landlines. You can find all these publications and more at lincolninst.edu/publications. Once again, we want to thank you for joining us this afternoon, and please stay tuned for upcoming events of the Municipal Fiscal Health Campaign from the Lincoln Institute. Thank you so long.